Hello, everyone. Welcome to Question Hour, our live Q&A session with Mr. Sunil Subramaniam, MD of Syndra Mutual on the economy, stock markets, and mutual funds. Thank you for joining us, sir. Hello, everyone. Welcome to Question Hour, our live Q&A session with Mr. Sunil Subramaniam, MD of Syndra Mutual. We've got several questions for you to answer, but before we get started, can you give us a small recap, please?
Absolutely. Thank you, Sweta, and good morning to all of you. So I just thought that, I've been getting a lot of questions on this, and I thought it'd be useful if I can just show a brief presentation. And the reason for the same is that, a lot of us are receiving a lot of data in terms of the markets, the valuations, and there are a lot of concerns. But at the same time, there are questions around what is the future of the economy and the markets. So I just thought that there's some new information we've got in terms of our study and the medium-term outlook for the Indian economy, which will ultimately drive the stock market. I thought I will present a few slides on what is our view on this same, right? And then take your question. So let me just share my presentation. Kindly bear with me. Yeah, 1 minute. So I trust you all of you. Shweta, you can see the presentation?
Yes, sir.
Yeah, okay. So basically, this is a peek into the future, right? We're now going to talk about what's happened in the recent past, the vaccination, all of those I think you're pretty familiar with. But in terms of the future, what we have observed is that the Indian economy is moving into a kind of sweet spot. So what we believe are that there are 6 economic cycles which drive the economy, and all of them are falling into place at this point of time. And for those who have been investing for a long time in the stock market, you'll be aware that the previous boom period for the market was 2003 to 8 on the back of a 2003 to 10 economic upturn that our country experienced. And we believe that these 6 economic cycles are coming together, coalescing at this point to give the same kind of an expectation that you could see a repeat of the 2003 to 10 economic story all over again. What are these 6 cycles? It's useful to remember them as the haptic effect. The haptic meaning the first letters of the 6 cycles that are presented here. So the H stands for the housing cycle, the A stands for the asset quality cycle, the P stands for the profitability cycle, the D stands for the deleveraging cycle, the I for the interest rate cycle, and C for the corporate capital expenditure cycle. Now, this haptic, the cycles, what is the time when we say when they are falling into place, what exactly do we mean? What we mean is that cyclical sectors go through a typical 4-phase period of growth, right? So you can start anywhere in this circle, right? Let's say that you're in a rising part of the economy. When the sector is rising, the rise lasts for a particular period of time, and then the sector starts to mature. Typically, what takes place in this migration from one spot to another spot is the balance between demand and supply. So in a rising phase, typically demand is exceeding supply. So prices are rising for corporate producers. So the markets obviously see rising EPS, and it's generally a very positive sign for corporate India. Then there is times when demand and supply get balanced, and you get to a maturing part where, because of the even equilibrium between demand and supply, the prices are acceptable to consumers, prices are acceptable to producers, and there's a period of good, strong profit growth, right? Then it comes to a place where the supply, because people keep adding supply to meet demand, supply starts exceeding demand. That's when then there is pressure because consumers have the pricing power and their prices start declining, and hence the industries also go through a lower EPS, lower profitability period. And after that happens, so naturally, either you will have some industry players falling out, collapsing, becoming insolvent, or you'll have some mergers and acquisition taking place, and the capacity gets rationalized. And that's the period we call bottoming out, when it's gone as far down as it can, and the prospect of further going down is very limited. That's the period when it's a bottoming. And obviously at the next phase, as demand then starts rising, you will then coming to the rising phase. So typically cycles go through these 4 periods, right? So these 6 haptic cycles that we talked about, the red dots tell you where they were in the first quarter of 2020, which is the pandemic quarter, right? And the green dots tell you where they are currently. So you can see the move that's been happening. So let's take, for example, corporate capex, right? Corporate capex was then in a bottoming phase. It has now come to the cusp of getting into a rising phase. Take leveraging. corporate leveraging, which is the deleveraging cycle, right? Corporate leveraging was somewhere near here, and it has moved further down on the bottoming curve, but not yet come into a rising part of it. Similarly, if you take housing, housing was then in a bottoming phase. Today, housing has come to a rising phase, right? Similarly, if you take asset quality, right? Asset quality was already then itself in a very sweet spot, continues to remain in a rising sweet spot. So each one of these, and whereas interest rates have bottomed out and finished their fall, are today at the cusp of going into a declining. So when we say declining phase, we don't mean dropping interest rates, we mean rising interest rates, because that's a sign of a drop in the overall demand for funds. So this, on this positioning basis, is where we are saying that the economy is in a sweet spot, right? And what is it about these sectors that is making us feel that we are in a repeat of the 2003 to 10 phase, right? So in the housing cycle, after a 7-year down, 2021 has seen an upturn, right? So that's the first for that cycle. For the asset quality cycle, gross NPL, non-performing loan ratios, have dropped by 5% since March 2018. So provision costs have dropped, credit growth is at its absolute bottom. It's setting the stage beautifully for it to get into an upcycle or the rising part. What about corporate profitability? After meager corporate profit of about 0.4% in the previous years, the period from financial year 20 to 22 is likely to clock about 51% EPS growth, and from 22 to 24, the next 3-year period, about 15% per annum. So clearly the stock market should reflect these EPS growths in terms of the price recovery, right? And then we come to the deleveraging. What is deleveraging? When demand is not there and corporates are still generating cash, they have an option of either investing that cash in mutual funds and bank accounts, or they have an option of paying down the debt they already took. So that seems to what corporates have done. The last 6 years have seen the debt equity ratio of India's stock market listed companies fall from 1:1 to 0.7:1. So a 30% drop in the amount of debt. What is the advantage of this? First of all, the credit rating improves, because the lesser debt you have, the better your rating. The second aspect of it is that when they need to finance capex, they decide to do, they are in a sweet spot to get the best interest rates in the market. And as we saw, our credit growth is at the bottom. So they are able to leverage and get to the bankers and negotiate for very good rates to finance their capex growth. So that's the advantage of the deleveraging process that's taking place. On the interest rate cycle, interest rates have bottomed out, as the graph showed you, right? And rate rises will happen, a matter of time, but they're not a point of concern as long as it's coming at a period when demand is exceeding supply. Then rate hikes can be passed on by the producers to the consumers without affecting their EPS growth. So the good point, and even in 2003 to 10, along with the economic growth, we saw a gentle rising interest rate curve, which is what we expect to happen this time too. Finally, coming to the corporate capex cycle, capital formation is at a bottom. It's down 7% from the 2012 peak, right? And from there, now the government has been spending more on infrastructure, and the housing come property cycle that we spoke about in the first line will also help improve the capital expenditure that's happening. So over the next 12 to 18 months, we expect a capex cycle should follow. So this is in essence is the summary of what I wanted to tell you all. So there are a lot of slides here, so I'm going to skip a lot of them, but focus on a few which reinforce some of these points. So on the housing cycle, right, we want to focus ultimately on one point. This is that residential India new launches and new sales have started going up. There's a V-shaped curve. Second is that residential inventories are at a 7 to 8 year low. So existing flats already developed are selling out fast, and realtors are already launching new launches, and new sales is also picked up. So that's one thing. The second thing here is that affordability levels are at the same levels of 28% of monthly income for an EMI as it was in 2003. So it's another strong reason why I believe that we are on the cusp of this upward cycle for housing. And home loan penetration at 12% of GDP has plenty of headroom to grow. And as you know, home loan rates are at a record 6.5% kind of levels today in the marketplace, right? On asset quality, right? See, most of the banks over-provided during COVID, have been writing back provisions, and despite writing back provisions, seem to have a very comfortable balanced provision buffer. So any surprises that come in, they are well provisioned to take care of it. At the same time, right, the debit bounce rates, check bounce rates because of COVID has dropped dramatically, as you can see, both in volume and in value, right? So that being said, bad asset cycle is also being reversed, and about 69% of bad loans are already provided for by banks who believe that things are quite good to support a increasing credit growth, right? And banks have used this period from the pandemic to actually shore up their capital. So tier one capital today for most of these big banks is higher than it was pre-COVID. So they're all in a good, strong financial position to support lending, right? On the corporate profitability side, it's still, we saw a decade of 2000 to 10 rise and 10 to 20 fall. And we believe the next decade of rise is now set to rise. It's a bottoming phenomenon, right? And good point is that return on equity for corporate companies is now again rebounding and it's reached about 12.5%. Why this is important is that when your own business is giving you a 12.5% return, then your temptation to put it in mutual funds is less. Your temptation to put that cash into bank deposits is less, and your temptation to reinvest in your business through fresh capex is very good because that return is the best return that you can get for your money. So this is a big trigger for corporates to start reinvesting in their own business through fresh capital expenditure, right? The deleveraging cycle we already spoke about, that how it's gone through cycles, and as I told you, from 1x it's come down to 0.7x. Interest rates we already spoke about. RBI has been strongly supportive with cuts in repo rates, pumping of liquidity to the extent of 30% of our country's GDP, as well as forcing the banks to pass it on to customers. So existing loans have seen 150 basis points drop, and new loans have seen 175 to 200 basis points of drop. So interest rates are at all-time low and very conducive for people to start borrowing, whether they be corporates for capex, individuals for housing loans, and for auto loans. Right? Corporate capex cycle is the last of the haptic, and here, if you see, I will focus on just a few of these slides. That the housing sector pickup is going to be one key driver. Then central government also spending about 1.5% of GDP all these years has upped it to 2.2 and this year to 2.4. So central capex is also a big driver. And the third is, where are they spending on places like roads, which creates demand for multiple industries like the cement industry, the steel industry, creates a lot of labor, employment generation, and all of that, right? And a lot of these industries, average capacity utilization has dropped dramatically. And as the demand now picks up, right, they will look at it at the next 3 years perspective and say that we need to invest in fresh capex so that we don't lose out of products to them, right? So, and lots of private sector have announced capex. So this is just the beginning. Like I said, it's a 12 to 18-month process of capital expenditure revival, right? And some major sectors which are going to do capital expenditure in a big way are steel, for example, doubling their average. Cement has gone through a V-shaped capex recovery, as well as the PLI scheme announced by the government, which is basically to counter the China effect. So corporates which want to move out of China, their manufacturing, India wants to position itself. The PLI scheme is essentially meant to target those kind of people, and that would naturally lead to fresh factories being set up and capital expenditure. Naturally, those order book will flow to Indian domestic companies, right? So how is the financing going to occur? Essentially, government has got this innovative plan called National Monetization Pipeline. About 6 lakh crores of their assets, instead of selling off those assets, they are actually monetizing them to help finance the capex. There's also the bank credit, which you spoke about, with interest rates an all-time low. During 2003 to 10, it went up at 23% credit growth per year. Right now, it's at 2%. So the room for that to go up and support this capex cycle is clearly very strong. In addition to which, India, next to China, has been the largest recipient of foreign direct investment. FDI investment is that which comes and supports the capital expenditure. And I think this is a big source of financing for India because it's now about $80 billion at a record high for our country, right? So overall, private corporate capex, we expect to rise from 9% of GDP to 14% of GDP. So just to summarize, I'm back to my first slide to tell you that these 6 cycles, which again I have repeated the summary points of these, right, are in a phase of moving either from bottoming to rising or from rising into the maturing pattern, and hence are an ideal position for India to have a sustained period of GDP growth over the next few years. So what is the haptic? Just to remember for you all, just keep this in mind, right? The HAPDIC, and this we believe, will take India's GDP up by $1.4 trillion over the next 5 years, taking us to a level of 4.1 trillion by 2025, which would then make us go ahead of United Kingdom in terms of size of the GDP, right? So from a portfolio perspective, what does this mean? This means that at Sundaram Mutual, we are looking at the investment cycle resurgence plus a consumption story to play. And in the domestic, we will play this through quality financials, consumer discretionary, building materials, industrials, and auto. And global recovery, which is also simultaneously happening, will play it through metals, specialty chemicals, auto ancillaries, and IT, the last three being export-oriented sectors, right? IT is also something that we are very bullish on because of the world recovery and the multi-year cloud migration and digital transformation that's happening, right? So that's what I wanted to just briefly share with you all. So now I trust these would have answered some of the questions which I had received in terms of the outlook and which sectors, but happy to repeat those. And I will now hand it over to my colleague Shweta, who will look at the questions that you have already sent, plus the ones you are posting on the live chat, and group them together for me to answer over the next half an hour. Thank you. Over to you, Shweta.
Thank you, sir. Now for the questions. The first one, do you think the 60,000 Sensex is a bubble? How do you see the Indian and world economy from here?
So I think that the one part of your question I've answered. The Indian economy's outlook is very bullish because of the haptic effect. World economy is also in a strong recovery mode. I didn't present the data here, but it is in a strong recovery. So the outlook for both Indian economy and the world economy is very good. Now, what if 60,000 is a bubble? Certainly not. The number 60,000 doesn't mean anything because it's just reflective of the earnings of the underlying corporations, right? As that is growing, these numbers of 60,000, 100,000, all those don't mean anything. Bubble has to be evaluated in terms of the valuations. And yes, in certain sectors, there is concern those valuations are very high, whereas there are certain other sectors where they are not so. So overall, I would say that 60,000 as a number doesn't mean it's a bubble, right? In valuation, some sectors are in a kind of bubble formation because there is excess liquidity which has chased them and run them up to very high levels. And so you can expect that those bubbles in certain sectors may get pricked. And so there will be volatility. But at the same time, I don't expect a sharp drop in the liquidity, especially domestic liquidity has been very strong and supportive of the cycle. And hence, there will be reallocation. There will be profit booking in some sectors and reallocation into others where there's value. Which are those sectors with that value? The haptic will give you.
The next one, sir. What will be the Sensex levels in the short, medium, and long term?
In the long term, 100,000 Sensex, I don't see it as a challenge. I think the short and medium is very hazardous to guess because it's a function of liquidity, earnings growth, whether another COVID-like crisis will come, how strong the fourth wave will be. So short to medium term projections are very hazardous to make. But in the long run, I don't see 100,000 Sensex. It's not a challenge in the long term.
The next one, sir. Is it good to invest 20% of corpus in US mutual funds now?
So I think you're going by the past returns of the US market, and I would encourage you not to concentrate your investments only in the US market. I think past returns are not the right way to look at it. I think, yes, US economy is going to grow. But remember one thing, that when you invest in the US stock market is not necessarily US economy driven. The US stock market has lots of companies which are getting their profits from all over the world. So it's a world economic recovery, and a market, because it's risen so much, has discounted significant portion of that recovery happening. So whereas there are lots of other markets which have not yet done that. So I would encourage you to look at a diversified international fund and not only a US centric fund. A diversified fund would be able to take advantage of the growth which is going to happen in some other parts, but the market has not yet discounted that fully. So I would say from some exposure to US is of course needed. So I would say a diversified portfolio and leave it to the fund managers to decide how much in the US and how much otherwise. I would draw your attention to one of the funds in the Sundaram stable called the Sundaram Global Brand Fund, which invests in the top 30 brands of the world. So essentially, they participate in the economic recoveries of a whole range of more than 50, 60 countries across the world. They are about 60% at last recall listed in the US stock market. So you get a 60% export in the stock market, but the underlying businesses are well spread all over the world. So I think that's a good kind of fund to look at an allocation. And 20% seems like a right number to allocate to international mutual funds at this time.
The next one, sir. Will principal mutual funds be merged with Sundaram MF schemes?
Yes. Yes. Each scheme of principal mutual, which is in the same category as a Sundaram scheme, will get merged to that. Where they are not in new schemes, they will be renamed as Sundaram schemes. As soon as we get SEBI approval, that will be made public.
The next one, sir. Are investments in gold instead of equity advisable as on today?
Not really, because gold is a negative asset class. When I say negative asset class, when things are bad in the world, whether due to corona pandemic, whether due to a world war, whether due to a trade war, whether due to hyperinflation, any negative news means there's a flight to safety, and gold is the first recipient of that. The other contra to gold is the US dollar. So when the dollar weakens, then people move their money into gold. Because who are the largest investors in gold? Of course, Indian consumers are one of the biggest, but they are a mass who driven by sentiment invest in gold. The real big investors in gold are the countries themselves, the sovereign wealth funds of countries. And for them, it's a question of protecting their capital. So what they do is when the dollar, because lots of the world's bigger countries, their surpluses are invested in US dollars. So when the dollar tends to weaken, they move to gold, right? So whatever, when the dollar tends to strengthen, they liquidate their gold and move to gold. So what's the outlook for the dollar? A strong US economic recovery is expected in a matter of time. When that happens, interest rates will rise and the dollar will also rise. So at such a time, by investing in the US markets through US treasury bills, these sovereign wealth funds will get the benefit of the higher interest rates, rising interest rates of the US market, as well as the rising dollar. So they will liquidate their gold and move it there at a time when the dollar is strengthening. So we foresee a future of strong dollar over the next few years. So I would expect that gold will be under a little bit of pressure from that perspective. At the same time, black swan events like COVID keep occurring, and we don't know whether there's another one around the corner. So if there is such an event happening, then gold could again be the recipient of safety funds. So allocating about 5 or 10% to gold in your portfolio is a plan B. It's a fallback to any risk that can arise. But it can't be the major asset class in your portfolio at this time for the reasons that I've just spelled out.
The next one, sir. Select focus or large and mid cap for the next 7 years?
Next 7 years would be large and mid cap, because I expect the economic recovery to be more broad based than a pure large cap story. So large and mid cap would be the better bet.
Should we switch to debt funds now or stay put in equity?
So I would suggest that if you are looking at switching to debt funds, means you're a little bit concerned about equity valuations, you feel there's a correction and you would like to park it in debt and then move back to equity at a right time. That's my summary of what you've asked. So I would suggest that you look at two products as an alternative to debt, because you look at the equity savings funds as a category, which is roughly 30% debt, 30% arbitrage, and 30% in debt. Sorry, 30% debt, arbitrage, and 30% equity. So even if the market rises for a little more time, you get 30% of the gain. But if it falls, there's 70% non-equity assets in your portfolio, which will protect you from the fall. And second, more advantageous to equity savings fund is the fact that it's got equity taxation. So when you get equity taxation, then even if within 6 months you want to make a switch, in a debt fund, you'll pay marginal rate of taxation or whatever your taxation levels are. Whereas in equity, you pay only 15% short-term capital gains. And if you have waited for a year because the correction has happened only after a year, then you get only 10% taxation. So it's a more tax efficient and a more stable vehicle to do that. Or even that 30% volatility that is there in equity savings, if you are worried about, if you want an even safer option with equity taxation, there is a category called arbitrage funds. Now, you can't expect great returns from arbitrage funds. They will be roundabout the returns you get from liquid funds, but they get equity taxation. So if you're very concerned, very conservative, put your money in arbitrage and then switch it back to equity when you feel the time is right. If you're willing to take a little bit of risk, I would suggest the equity savings funds as a good category to put your money, park it for the temporary period of volatility and move back into equity when you feel that the valuations and timing are right. That would be my recommendation to you.
The next one, sir. What is your view on investing in focused funds versus investing in Flexicap?
So focus funds are in a way a poor man's PMS, right? Many actors are referred to as poor man's Amitabh Bachchan or something like that, right? So what a PMS does is take very high risk, high reward bets. Works sometimes, doesn't work sometimes. Focus mutual funds, because SEBI says only 30 stocks can be taken, behave in a way like PMS funds. Of course, given the fact that they are retail products sold to the retail public, there is a little bit of diversification among sectors within the 30, but there's very limited amount that you can do when you're limiting to 30 stocks. Now you're comparing those with Flexicap funds. Now in focus funds, please look at the offer document to see, are they focused multi-cap or Flexicap, or focused large cap or focused mid cap. So if they are focused within large cap, within mid cap, then there are no comparison to Flexicap, right? So focused multi-cap stroke Flexicap funds and Flexicap funds, right, are essentially to be looked at like saying focused funds take higher risk, higher reward due to concentration, whereas a Flexicap fund takes a lower risk, lower reward due to diversification. So based on your risk appetite, you can choose the focused. If you're more risk comfortable, choose focus. If you're more risk averse, choose Flexicap.
The next one, sir. I've been investing in Sundaram Financial Services Fund for 2 years. Should I stop and move it to Sundaram Services Fund now?
Not necessarily. I think that while services fund will also do well, I believe the banking and financial services space is also one of our strong picks in terms of sectors. So actually, it should also deliver good returns. What is the difference between the two? The difference between the two, that services has a wider gamut of services. It's not only financial services, but second is it's also multi-cap, whereas the financial services fund is a large cap fund. I think the last count it was 75 to 80% large cap. So if you are wanting to play the broader market recovery, services is a better play. If you want the comfort of the larger cap space, then financial services is a better play. So take your choice accordingly.
The next one, sir. Do you think the market will be bullish after Diwali? If so, which sectors will show an upward trend and which will be showing downward?
See, we'll have to wait for Diwali to see whether there's a third wave impact which comes around the fact the crowds of pre-Diwali shopping, right? We already have the experience of Kerala and Onam. In just post-Onam, in one day, it shot 25,000 cases. So the whole gathering of groups at shops for the Onam festival purchases proved to be very bad. And till today, Kerala is the leading state in terms of COVID infections post that festival. So Diwali again is a big risk for the country from a COVID perspective, and how people be safe, how the vaccination, we are at about 70% adult vaccination today and 51% overall population vaccination. So if a significant proportion of non-vaccinated people are out in the shops, get COVID, transmit that to others, it's a iffy thing. So while the festival season is expected to lead to a boost in demand, immediately post that there could be a spike in COVID, which could tone down everything. So I would say that hazarding a guess on a post-Diwali boom in the markets, right? The markets will discount whatever the news flow that comes out. So I would rather we wait and watch to see the data before taking a call on that very short-term outlook.
Next one, sir. Will principals Mr. Ravi Gopalakrishna manage combined Sundaram large and mid cap fund?
That's a decision that he has to take. As you may be aware, we have appointed him as the Chief Investment Officer of our fund house. So Ravi himself will take a decision on which funds he will manage within the overall portfolio. So I would leave the decision to Ravi to communicate as and when he joins us. He has accepted the offer. It's a conditional offer subject to the regulatory approval by SEBI of the transaction and us closing the transaction, which should take about 2 months after SEBI approval, which we are still waiting for. So once Ravi Gopalakrishna takes over as the CIO, he will then have made the decision which funds he will manage personally and which he will oversaw. As a CIO, he will oversee every fund's performance, right? So that decision is something that you will have to patiently wait for Ravi to communicate, to decide, and to communicate post his joining our company. Kindly be patient on that front.
Next one, sir. Any new thematic NFOs from Syndra Mutual?
Well, given the principal acquisition is under progress and we'll have to absorb all those funds and do in the transition period, right? So I think to put a new NFO, neither will SEBI approve it because our application for purchasing Sundaram is currently being discussed by them. And at the same time, our energies will be more in terms of making sure that the merger takes place smoothly with very little, disruption to investors' plans. At the same time, fund performance of some of the schemes have not been great, so we want to push them up with Ravi joining us with the team. I think there are a lot of things that we need to do over the next 3 to 4 months. So a new NFO probably will wait for this whole thing to stabilize. So I would argue that probably in the next year is when we will look at doing NFOs.
The next one, sir. What is the reason for the downward trend in pharma shares?
Well, pharma ran up because of liquidity and the expectation that the COVID will last a long time, hence demand for pharma-related products will be very high. Obviously, a lot of profits were made in pharma because it saw a fantastic run to the post-COVID phase. So naturally, now when people look at where to put the money, there are other more attractive sectors, like I mentioned, the infra-related, industrials, all of those, consumer discretionary, all are looking attractive. So somebody has to book profit somewhere and then shift their allocation. So part of the reason is that while pharma is a more safety component, the high growth part of the investments, which pharma actually delivered high growth over the last 18 months, is now obviously shifting to newer high growth opportunities. So just a sectoral leadership change that's happening, as pharma is suffering the brunt of it. And as a safety element, it will be provided fairly decent return, but it will not give you those very high growth rates which other sectors can deliver.
The next answer. How will PSU banking stocks fare?
So I think that PSU banking stocks have been, how do I call, they're perennial bridesmaids, which is that they look very attractive, but nobody wants to marry them. So they on valuation are always at a deep discount to their private sector counterparts. So they look attractive when you look at purely as a price, as a bargain, as a Shravan sale or Adi sale, as they call in Tamil. They always look attractive from a price valuation perspective. But it is a fact that political interference, the bureaucracy, the inability to hire and fire people, to get good quality workforce, is always been a challenge for them to fully maximize opportunities, right? Now, when the economy goes through a very boom phase, then every bank gets a share of its business. And though private banks will get a lion's share of the business, the small share the PSU banks gets means that their profits will grow faster than expected. So from a pure value perspective, they look extremely good buys. But the point is that they will continue to remain value forever. It's only that are they at more deep value today and lesser deep value will give you a return. But to me, in my mind, public sector banks will never overtake private sector banks as the darlings of the stock market. So bear in mind that you will make money from investing in public sector bank stocks, but the kind of money that you make from them, perhaps you will make much more from investing in other growth, good quality private sector bank stocks. So when I say public sector bank, obviously I'm using one word for all. Within public sector banks, there are very professionally run, very good public sector banks too. So I'm not denigrating public sector banks. I think that the top public sector banks are as good as the top private sector banks. But the point is, the second quality private sector banks are far better than the second quality public sector banks. So overall, when you look at that portfolio, right, you will have to bear in mind that you have to be very picky and you're going to choose the right, well-capitalized, good processes, good branch network and reach kind of a bank, whether they are private sector or public sector, to make your investment.
Next one, sir. Any world indices fund from Sundaram MF soon?
Well, like I said, any new fund from our stable is not likely to come soon because we are more concerned with the principal acquisition and integrating the staff and the schemes and all of that. So in the future, we will look at it. And yes, the world index funds are all one of those things that we will evaluate.
I want to start a monthly SIP for approximately 10 years, rupees 1,000. Please suggest a fund.
I would suggest the Sundaram Services Fund for the reason that services is more than half of our economy, but is only 1/3 of our capital markets. But this is narrowing fast. And so the capital markets is seeing a better valuation for services sector companies and also seeing lots of new companies with their IPOs coming in from the services sector. At the same time, the whole starting from demonetization to the GST to all of that, the process of formalizing means that a lot of the smaller service sector companies are getting merged with the larger ones who are coming into the stock market. So clearly, the stock market should give you a reasonably better than broader market return from a services sector perspective. And the services sector fund is a multi-cap fund. So once it's multi-cap, it means that it's ideally positioned to capture domestic growth story also, besides the stocks which are the favorite of FIIs. So I would suggest the 10-year outlook, the services fund looks to be a good investment to make.
The next one, sir. Is it a good time to invest in short-term debt funds now?
Well, I would argue that interest rates are in a rising cycle. So when you put it into any debt fund with a duration, right, whether it's short or medium term, there's going to be mark-to-market losses which will come and tone down your returns, right? So, and you remember that you need to wait for 3 years, right? But in the 3 years, definitely I see an interest rate hike happening. So my argument would be that if you want to park your money for liquidity and safety purposes, choose arbitrage funds which have equity taxation, but the returns will be very low. Choose liquid funds, which thanks to the SEBI rule, on pure money funds, every 30 days they get reinvested. So even a rising interest rate, they will not get locked into the longer term and suffer mark-to-market losses, but they'll capture gradually the interest rates rise, they'll capture in their return. So liquid funds are a good option, but you have to wait for 3 years even in a liquid fund, right? So those are my two recommendations to you to look at from a debt perspective. If you have a 3-year outlook, liquid funds. If you don't want a 3-year outlook, but keeping it there temporarily, use arbitrage as a good category.
Next one, sir. I have invested in Sundaram Midcap Fund. Can I purchase additional units now? Is it the correct time to buy?
Yes, the fund, while on a long-term track record is excellent, over the recent few years has underperformed, as you may be aware. And that is because we were very small mid-cap and we were very domestic economy focused, which from 2017 to now has hurt. But now on, as you would have seen from my presentation, we expect the domestic economy to dominate and we expect the mid-cap stocks that are in the portfolio to outperform. So it will be a good time to make fresh allocations to the mid-cap fund because it is in the recovery path.
The next one, sir. Why FIIs sell out in emerging markets when US interest rate increases by 0.25 or 0.50 bps? Will it offer them a higher return than what they get in equity in emerging markets?
Yes. So good question. And let me take about 2 to 3 minutes to answer this because it's a very good question. So what happens is that, see, in the foreign markets, when interest rates are low, right? When are interest rates low in foreign markets? When their growth prospects are low. When their country's growth prospects are low and the central banks are pumping in money. So there's ample liquidity because they want to revive their economies. So they want to revive. They're not reviving yet. So interest rates are low, plenty of money is available. What happens is funds called hedge funds. What do? They put in only 20% of their money, borrow 80% of the money at those cheap rates and invest 100% into emerging markets. And where do they expect to get returns? First, low cost of funding for the 80%. The second is that since those currencies are on a downtrend, their currency will be on a downtrend. So they're borrowing in a weakening currency, which is going to weaken. And in the emerging markets, because the growth is there, their currencies will be strengthening vis-a-vis that. So they get a double gain. One from the actual growth in the emerging markets in the stock market, thanks to the economy's growth there. Second is from the currency appreciation vis-a-vis the dollar from which they borrow. So they get a double whammy when the interest rates rise. And since they put in 20% of their money, right, 4 times the return. So if they get a 2% return, it's actually 8% for them. Because 24 are 80, 4 is borrowed money. Other people's money they have taken, right? So the expansion, right, of this double currency plus economy growth in emerging economies gets multiplied 4 times when they look at it from that capital return perspective. So all hunky-dory, that's why India got such a huge lot of money. And by and large, the Indian rupee has been stable. So recently there has been some depreciation. By and large, the Indian rupee has been stable. So even if, let's say, it's not an appreciating currency, their losses from emerging market have been minimal. Okay. Now look at it when the situation reverses. Even a 25 basis points hike or a 50 basis points hike, you have to multiply it by 8 for them, by 4, right? So a 25 basis points hike is actually equal to a 1% hike for them, and a 50 basis is equal to a 2% rise from them. Same time, what is the signal from that rate hike? Is that their economy is recovering, which means their currency, which is the dollar, is likely to strengthen. So when the dollar strengthens, then the rupee will weaken, then they lose money on account of currency. So there's a double whammy. There's a 2% increase in their cost of funding, and then there is a drop as of the valuation because of the currency weakening. So they get a double whammy on both sides. That's why they're very sensitive to even small, because the multiplier effect on returns also comes in multiplier effect on dropping returns, right? So I hope I have answered that question. Why even small rate hikes are bad news from an FII investment in emerging markets like India is concerned.
The next one, sir. When we know that inflation and interest rates are likely to increase in the near future, why would anyone invest in existing debt?
So the reason is that so inflation and interest rates. So look at it this way, right? Inflation in India is a function of three things, right? Food inflation, which is a big part, imported inflation, which is crude and other related commodities, and demand side inflation. So when you say it's going to rise, now oil prices, how far they rise is a matter of judgment, right? There's already been a rise, whether they will continue or not. There's a fight between US, Russia, Iran, Iraq, OPEC, Venezuela, all in the market. So oil prices are hard to predict, right? So you can't guarantee that oil prices will go up, so inflation will go up, number one. Food prices, we've had good monsoons, we've had good crops, so food inflation actually is trending down. So I would argue that they will counteract this increase in inflation. Third is demand. We are just coming off the COVID pandemic where demand has been low, expecting a V-shaped recovery. As and when that happens, it only absorbed unused capacity. If you not saw that capacity utilization chart I put up, it's only at 72%. So until that capacity comes to the top, it's unlikely to lead to a strong price rise. So I think overall there's a benign outlook on inflation. So I would argue that inflation is not so guaranteed to rise to very strong levels yet. That may change in the future. Second is you mentioned about the interest rates, right? Like I said, RBI has been very supportive of the government that we need to keep a soft interest rate stance to help the economy revive. And Mr. Shaktikanta Das has just today got a 3-year extension because of exactly these actions, that he's very in sync with the government. So as long as India wants to continue to remain on a good growth path, RBI will try to continue the accommodative stance, will try to keep interest rates from rising as long as possible. Further rate cuts will not happen, but that. And what is supporting them is that even the Fed is saying that while they may do tapering in a few months, they will do interest rate hikes only by 2023. So that gives RBI additional cushion not to hike rates in India. So these two factors, yes, when corporate demand picks up for capex, when rural retail demand picks up over the next few years, interest rates will gently rise. But so now coming to your question on the debt funds, why would anybody invest in debt funds? The point is that if you are looking at it from a 3-year perspective, and if you say invest in short-term funds, then the short-term funds benefit from reinvesting their money at higher and higher interest rates in a rising interest rate scenario. So if you're not investing in a medium-term fund, which has already taken medium-term assets in its book, they will see a mark-to-market loss, and so it's not sensible in a rising interest rate scenario to put in long-term or medium-term funds, right? But to put it in short-term funds, as long as you don't need the money for 3 years, you get the benefit of indexation on your taxation. So any rising inflation will come to your aid, number one. Number two is that the redeployment. So liquid is the best category because every 30 days it gets redeployed. Or ultra short term, I think it's got a 1-year duration. So money which gets redeployed, if you're waited for 3 years, you will get the benefit of the tail that the rising interest rate coupons will actually come as yield returns to you without a mark-to-market negative loss, right? So I hope you've understood that. So for people who have a clear 3-year outlook that I don't need my money, to put it at the shorter end of the curve means you will get the rising interest rate curve, because if you put it in a bank fixed deposit, you are stuck with the interest rate the bank is giving you today. Though 2 years from now, the bank may be paying you 100 basis points more, you cannot take advantage of that. But in a debt mutual fund, you will get the advantage for the last year of that interest rate hike, right? So short, very, very short term liquid kind of funds are actually fairly decent opportunities, provided you are willing to wait for 3 years. That's the reason you would invest in debt. Yes, to your question on doing in medium term debt, yes, it may not be an appropriate time. Now, finally, one additional thing you need to bear in mind in terms of the fact that recently there's been a lot of news reports of India being included in the bond indices of the world. So far, we are not in the bond indices because our markets are very tightly controlled. So bond indices say no, unless there is free flow of capital, we will not include. Now, government has been lobbying with them and making efforts because as a source of financing for India's economy on the debt side for the government itself, right? Money from abroad is not able to come to the fullest extent. Only about $5 billion, the government has got a limit. But once we get included in the bond index, demand for India will go up. So that influx of long-term money could be a counter to this rising inflation, rising interest rate story, and hence could delay this whole rate hike by whatever period of time. So it's important to keep a constant wait and watch, because that is a counter to a rise in interest rates. So just keep that also in your mind, a track on when. I think what I read recently is that middle of next year is when we expect India's inclusion in the bond indices.
Next one, sir. Is Sundaram large cap preferred over Sundaram Flexicap, considering small funds might not do well consistently?
I don't have a Flexicap fund in the Sundaram stable, so I don't know what you're comparing with in terms of that. If you're comparing Sundaram large cap to Sundaram small cap, well, it's a very different approach, right? A large cap fund is essentially meant to be more safety and protective of your capital, whereas a small cap fund is meant to be more of an absolute return, building on the growth story of India. So, outlook time frame, less than 3 years, large caps are good bets. More than 4 to 6 years, small cap is a good bet. Second is your risk appetite as an investor, right? If you're more conservative, then obviously large caps are down your alley. If your more risk appetite is higher, then small caps are your preferred choice. So I think it essentially depends on A, term outlook, B, the risk perception in your mind of yourself.
The next one, sir. Do you have any financial products that will give a return of 8 to 10% and at the same time it is as safe as RBI bonds? It should have liquidity.
No, we don't have any such products because we are in a risky marketplace. When we invest in the stock market or the debt capital markets, we are dealing with risk. So you cannot assume that the RBI bond safety can come to any risk because RBI is risk free. It runs the government of India's balance sheet, so they will never default. So you cannot compare with RBI and their aim get. Our mutual fund industry's attempt is to manage the risk to deliver you a return. But there are times when the risk dominates the reward. There are times when reward dominates the risk. There's a timing issue, and so a longer term investment is what generally delivers returns. But if at the time when you need your money, a COVID pandemic has struck, you could have lost your entire wealth in that. But we are investing only in that kind of a risk-oriented market. So whatever be its pluses and minuses will be faced by us and by the investors. So the kind of 8 to 10% return with RBI kind of safety and liquidity, I think that's not possible by the mutual fund industry.
The next one, sir. Which sectors would do well in the next 5 years? Are IT and healthcare overstretched already?
Healthcare is a bit overstretched. IT, I would argue that it's not. So, but it is, the valuations are high. But I believe that the expected EPS growth and business growth of these companies will justify the kind of prices. So you will get a decent return from them. Don't expect huge returns, but decent returns from IT. Pharma, yes, is a little bit overstretched because it is a specific pandemic related thing which made pharma rise so much.
The next question, sir. Large cap companies are not an investment in Sundaram Diversified Equity Fund. Why? What are the fund's prospects?
I don't agree with you. If you see the fact sheet, I think it had more than 75% in large cap funds. So I don't know where you got your data from. Kindly relook at it. This was the case in 2018. At that time, yes, it had 50% plus of mid and small cap stocks, and that is what led to its underperformance. Since then, the portfolio has been gradually increasing the large cap component, and today it is almost 80% large caps, and hence the prospects for the fund, I think, are fairly good in the coming future.
The next question, sir. I'm an investor and my time horizon is 12 to 17 years. I want 20 to 25% CAGR every year. Could you please suggest specific ideas or funds that I could invest in?
None. I don't think that we can give you 20 to 25% every year. Right? If you look at funds, will they deliver a 25% CAGR? Yes, but it will be like minus 10%, minus 25%, plus 65%, plus 85%, minus 20%, minus 15%. Year on year returns will vary widely. But if you have stayed invested for that period of 12 to 17 years, getting 20 to 25% is a possibility in mid cap funds, for example, and in multi cap and flexi cap. So you can take your pick, but don't expect this to be returns every year. You will get those annualized at the end of having waited for 12 to 17 years. But next year, your 100 may become 88 rupees. And then 88 will become 120 rupees. Then 120 will come back to 95 rupees. So that volatility is inherent to the equity markets and to the nature of the investing business that we are in. So when you say per year, that's what I get worried. But if your expectation is that at that rate of compounding over 17 years, can I expect that to happen? That's a reasonable expectation. And I think you can choose multi-cap or mid-cap as that category to choose for investment, but with the proviso of being prepared for intermittent volatility right through the journey of 12 to 17 years. And finally, important point is that the 12th year or the 17th year, we should hope that there's no COVID pandemic hitting India, something like that, because that event-based risk on the day that you want the money could destroy a lot of the money. So if you are saying 12 to 17 years, set yourself a goal, right? You mentioned you want 20 to 25% per annum. So take 100 rupees if you take, compound it at 25% per annum, okay? And let's say that number 100 comes to 352. I don't know what that number will be, 352, let's say, or maybe 3,520, whatever. Between the 12th and the 17th year, the day you hit 3,520, do you have the guts to pull out your money, regardless of what the market participants, the pundits, the people like me are telling you about the future? Because your goal was a 25% per annum return over that 12 to 17-year period. So in the 13th year or the 14th year, if you hit that goal, ruthlessly, you must liquidate, take that money and put it into a safe bank deposit or a liquid fund or something like that. Then you can assume. Because somewhere in the 12 to 17th year, I think this will happen. But if you keep saying, oh, I've reached that now, but now I want to make the 3,500 into 5,000, I'm sorry, that market can let you down big time. So have that discipline, invest with that idea. And if 25% hasn't happened, but let's say 19% has happened, what's wrong? You still beat an inflation and all other asset classes by hands of margin. Book your profit and take your money away then.
Next one, sir. Should I hold mid caps and small cap funds for 5 years from now?
Yes, simple answer.
The next one. Which of these sectors will outperform? Banking, auto, PSU banks, property, metal, IT, NBFCs.
Banking, auto, banks, IT, NBFC, and IT.
Yes, sir. And metals.
No. I said no to metals.
Oh, okay.
The ones that I named are the ones which will outperform.
Got it. Thank you, sir. The next one is, it appears Sunil Mutual is losing track of benchmark indices while evaluating performance of various funds. During the last 2 years, the mid-cap has underperformed. Any action plans to arrest the falling performance?
Yeah, I acknowledge what you're saying, and it has been a reality that our funds have underperformed their benchmarks. But if you talked about the mid-cap fund, if you go back to 2 years back, right, and look now, there's been a steady improvement in its underperformance versus the benchmark. It's still underperforming, but from a huge underperformance, it has come down to a medium, and we are working towards improving that. So over the next year, 2 years, we are confident that it will bridge that gap and start outperforming its benchmark. We already put the process in place, and including a change of fund manager has happened for that fund about 5-6 months ago. So we are seeing the progress, and if you are patient with it, it will ultimately become one of the top funds in the industry in terms of performance versus benchmark, is our hope.
The next one, sir. Considering that SEBI has capped the overall fees, how do you see the distributor's role? Do you feel that the MF industry would see more direct investments as opposed to through the distributor network?
I think that the answer lies in expanding the market, because mutual fund penetration is still very low. So I think whatever capping the fees and hence the trail commissions being capped are a reality that we have to live with. So the answer for a distributor is to expand the number of clients. Yes, but will direct be a challenge? Yes, it will be a challenge. So I think that by the distributor choosing the right set of funds for the customer, you can counter the fees that he saves between a regular plan and a direct plan. So if you're smart and give good asset allocation to the customer, I think you can still end up beating. But will direct grow? Yes, it will grow because the younger, new age customers are more do-it-yourself, confident of themselves, touch of a button. So nobody can prevent the growth of direct. That will be there. But it's up to the distributor to go and show the value that you can bring to the table through your knowledge, through the training, through CFP qualifications, and all of that to make better asset allocation choices, choosing mutual funds, so choosing the right kind of asset classes for the customer. You have to demonstrate the value to get the business from the customer. Yes, he will always compare you with direct, and that is the reality. But you have to be smart and on your toes, on top of knowledge, market developments, economy, what's happening, to be able to hold that customer to your fold.
The next one, sir. What are index funds? Should they be a must-have in one's portfolio?
So index funds are nothing but funds which exactly invest in the proportion of the stocks in the index for your portfolio. So essentially, you're buying the market. Now, should they be a part of the portfolio? It all depends the reason for investing. See, basically, equities as an asset class is a longer term, guaranteed to beat inflation, a kind of an asset class. Okay, so if you are satisfied with that, then index funds will help you. But if you feel that you're taking the risk of that and there's a possibility for getting better returns than the market through active fund management, then active fund management is the way to go. So, are they a must-have? If you're a first-time investor, trying the index funds gives you a good exposure, gives you good knowledge and learning, but you should add active funds also to the portfolio, because then you will know, right, what is the difference between the two. So as a first time investor, I would encourage you to have a small piece of index funds in your portfolio, but at the same time, don't ignore active management, because active management over the long run can deliver that extra return that you're taking for the risk anyway that you're taking of the market, right? So you get the market risk reward through an index fund, but you can get extra market reward with a lesser risk due to diversification through active fund management. But it is something which will deliver over the long term. Don't every day sit and compare the active fund with the index fund and say this is happening, that happening. Life happens over a period of time and evens out. And the expertise and diversification, the two strengths of active management, will come to the fore in the long run.
Thank you, sir. In the interest of time, we'll just take two more questions.
Okay.
How will the petrol price hike impact markets?
Petrol price hike will have limited impact on the market, because I think the market doesn't really worry about what's happening to consumers and any inflation that happens. So there will be a derivative impact on the market. Two reasons. One is petrol price leads to inflation, and inflation leads to RBI reversing his competitive stance, and hence there could be some impact on the market. That's one way. The second way is that the petrol price hike for consumers is one thing, but for products like car industry, the paints and tires, everything is linked to petrol prices, because they're all derivatives from that overall crude pool of products, right? So their costs will increase. But if at that time demand for their cars or whatever is going to be higher than supply, then the price increases in the petrol crude related can be easily passed on to the consumers, right? So these are the two factors through which can affect markets. If demand is weak, then those EPSs will drop and market will see the effect. Second is the inflation rises, then RBI may reverse its accommodative stance. But I don't see both as at that level of to be a concern. So as far as the present petrol price hikes are concerned, I don't think they will have any impact on the stock market at this current point, because I think that the festival season should see a V-shaped demand, and hence small price hikes or account of the petrol price hike should be easily passed on to the consumers.
The last question, sir. Are ESG funds good?
There's no fund which is good, no fund which is bad in the market. Okay, so ESG funds are just another option of saying that the world is moving to a more sensitive world, where we are very careful that things which are harming the world, we don't want to invest and help them to grow. The proportion of people who are valuing it is increasing, and that's where the concept of ESG has come up, because people are getting more conscious. Funds, institutional fund investors are getting more conscious, and they want to build a better world and say, okay, it's only that which helps build a better world. That which pollutes, that which causes medical problems, that we will avoid, right? Now, it's a nice and good feeling to have. Is there evidence that the stock market rewards such kind of a thing? It's a very, very mixed bag, right? So I think conceptually in the long run, it's believed that it will add value. That's why a lot of new fund offers from mutual funds have received good response from the investing public saying, hey, it's new, that's worth trying. But I think we'll have to wait and see over the next 3 to 5 years to see whether that reality, actually turns into practical returns, right? The increasing price differential, which are ethically managed company, which doesn't pollute the environment, versus another one which says profits is what I want to help with the environment. That balance, right, is an interesting thing, and we'll have to wait and see. So the answer lies in the fact that would you go and pay X thousand rupees more for a 5-star rated AC versus a 2-star rated AC, right? If your budget is a crunch, you'll say, okay, environment be whatever, I want to save money for 2-star. If you're surplus with money and you say, no, I want to be caring for the environment, you will go for the 5-star AC. So these are the choices which actually drive these things like ESG. So I would say that as an investor, then ESG funds fit the type of investor who wants to be socially responsible, and hence by his investing decisions wants to support a socially responsible world. But we don't know whether there are enough people who are socially responsible who will then deliver better returns from such products, right? Only time will tell that answer.
Thank you, sir, for answering all these questions.
Thank you. Wish everybody a happy Diwali and a good festival season to come. And do stay safe through this corona pandemic so that a third wave or a fourth wave is kept under control. Be responsible, wear masks, and observe social distancing. All the very, very, very best.